18th of November, final session of the week. And, what we've seen overnight, I would say, is pretty typical of what we've seen all week, and I would say sort of back end of last week. The key theme is certainly dollar strength. It is bond yields rising, and this dollar strength just weighing on the commodity space. We'll talk about gold and oil, but let's just definitely start with dollar strength. And you could say this is, it's a continuation of the theme, as I said, and the theme is continuing because ultimately Yellen spoke yesterday and really didn't alter our expectations, and our expectations are that they're definitely going to hike. The Fed are going to make their move in December. Just to kind of very quickly review, as I'm showing you this weekly chart on euro dollar, we've just now, briefly got below the 106 handle there. That hasn't happened since December 2015, of course. But just to kind of remind you of what Yellen said, and it was nothing that we weren't expecting, to be quite frank, but what she said was the Fed was close to raising rates. She noted that the case for hiking relatively soon would continue to strengthen as long as incoming data held strong. She also signalled the need for the FOMC to avoid delaying rate increases for too long, as it could end up having to tighten policy relatively abruptly in the future. So I think that's perhaps the most interesting sentence of her whole speech in front of the Joint Economic Committee yesterday. It was this idea that, it looks like the Fed have decided that the risks of waiting any longer, the risks are now greater, i.e., let's hike now, because if we don't, we might end up having to hike a lot faster as we hit 2017 and Trump rolls out his fiscal stimulus program that drives inflation up faster than we were expecting. So that's the kind of main takeaway. Probabilities of a Fed rate hike based on Fed funds futures have increased from 94% to 96%. So it's gone from being almost certain that they're going to hike to being almost certain that they're going to hike. So this has really just led to a continuation of the theme. That's it. There's no other explanation of it. So let's look at Eurodollar here on the weekly chart. This is further sort of breakout of the 107 area, and you can see clearly what the target is here, and it's the 105 handle. We mentioned this yesterday, or at least Vass raised this idea, and I think it's a good one to raise. Perhaps the one hurdle for the Fed hiking now is actually just how strong is the dollar by the time we get to the Fed meeting in the middle of December. At this rate, we could be below 105. We could be making new... Well, let me just go right back. Obviously, if we broke the 2015 double bottom, then, you're really looking at... let me just go back on the chart as far as I can here. So we're going back to the start of... so if we break the 2015 double bottom, which officially on the futures at least is at 104.63, that was the start of 2015 or March 2015 low. If we were to break that before the Fed meeting in December, then we're looking at a 14 year low there as we head into that meeting. So perhaps that is the only single factor that the Fed might be concerned about, but we'll have to see. But yeah, at this rate, certainly the dollar strength is continuing. We've got dollar yen up through the 110 handle overnight, and so and just thinking about cable dropped lower overnight as well, breaking this kind of double bottom that we'd had from the previous two sessions around about the 124 handle. We got down through that, found support at S1. And now actually we've just popped back higher a little bit on cable. But if you go to a daily chart for cable, which is obviously faring a lot better than the euro and the yen is, but we're just down testing that low from earlier in the week, which was also the low back on Thursday, and we got a low in here from Friday's session, from the 9th. The election day session is 123.61. But yeah, dollar strength, same theme for bonds. yields continue to rise, bond prices continue to drop, as we continue to price in not only the Fed hike, but also this fiscal stimulus and really a real shift in how we think inflation expectations are going to map out as we go through 2017. Now, quite similar to the euro dollar, check out T-notes here on the weekly, because we're right down, about to test the December 2015 low. And then you've got the kind of summer low for T-notes, which is down on the 125 handle. But it's a very similar chart to euro dollar, this. So be aware of this key technical level on T-notes at 125.14. That's the December 2015 low, okay? How's this having an effect on the commodity space? Well, gold. Let's show you on a weekly chart for gold now, whilst we're on the kind of long-term analysis. And we're here, basically. I've been talking about this level for a while, really all week. We're basically here. Let me just remove that line. Just move that slightly. When I say we're here, I mean the 112 handle, the kind of start of June low, right on the 112 handle. Today's low is at 12.01. So this is dollar strength pushing us lower. It's also just that certainty that the Fed are going to hike also, which is weighing on gold. So, as I've been saying, I think this looks pretty attractive now. I've been waiting for this price for a while. Patience has paid off, and here we are. The only risk to this trade for the medium term is if you do get a dollar breakout. Let's say euro dollar trades down and smashes through the 105 handle and sets a new 13-year low. That's your one risk to the gold trade here. Outside of that, I think there are no risks to it. I think the inflation expectations rising should be a positive for gold, and hasn't been yet because the dollar strength has overridden it. And then, of course, you've got safe haven. There is plenty of uncertainty out there. Talking of uncertainty, here's something to be a little bit worried about. Let me change my screenshot to the Italian 10-year government bond yield. Now look, all bond yields are rising here. It's not an Italian thing. I just showed you the T-notes chart, and T-notes trading back to test the December 2015 lows when you're talking about price. From a yield point of view, Italy here is actually, forget about the December 2015 highs on yield. Here's the Italian bond yield gunning for a test of the 2015 highs up at 2.4. So not a big move, continued upside on yield. And this is, of course, now not only these yields moving as the rest of the world's yields are, Italy's are also getting an extra boost to the upside as a result of the political risk in Italy as we move ever closer to this referendum, constitutional reform referendum at the start of December. So this is something definitely to monitor. We're not there yet. This 2.4 handle on the yield for summer of last year is very important. This is a particularly important price point or yield point to keep an eye on in the next 2 to 3 weeks. If we break 2.4 on the upside off the back of elevated political risk, then this is really going to start to have an impact on global sentiment. And the euro's value, if you get euro weakness along with dollar strength, well, perhaps that could be the catalyst that drives that euro dollar back down below the 105 handle. So Italy on the radar, obviously. Also going into this weekend, we've got the first sort of primaries for the French presidential race. So we're going to start to get some news flow on that, which also could have an effect on sentiment. A negative one, I would say. This really starts to bring that French election into the spotlight, onto the front pages, and along with the Italian political risk, obviously this can really start to play a role on sentiment. So for gold trades, long gold, this again should play nicely into that kind of idea. So just thinking a bit more short term, we've definitely got a bit of downside here on the equity space. You've seen the S&P make a new low for the session as I've been talking. The DAX on the left here has also New lows for the day and picking up at a bit of speed here. So down through the 10,700 handle. Let me just zoom in a bit for the DAX, which is just testing the pivot level now as I speak. So new lows for the session down through the prices we were finding support at into the US close last night. We've had Draghi talking this morning, not that he said anything, just reiterating the fact that the ECB's objective will remain having an inflation rate target at or below 2% over the medium term. He hasn't really said anything of interest other than that. So, we've definitely got a little bit of a similar vibe, as I've said, for dollar strength, yields rising, commodities under pressure with oil moving lower as well as a result of the dollar strength. But the only thing that's not a continuation of the theme is that now we've got equity weakness. You've seen equity strength, of course, in the aftermath of the Trump election win, and now you're beginning to see that just get tested a little bit here. So interesting start to the session for sure. The other thing, just thinking about Brexit, just to update you on some of the other news flow. We've had Schäuble, here he is, just talking overnight with regards to the whole Brexit deal situation, and he was quite forthright, not in a good way from a soft Brexit point of view. He's very much saying, look, you can't have the best of both worlds. You're either in or you're out. There's no a la carte menu, borrowing a phrase coined by Donald Tusk a few months back. And so we are hoping that Germany are the kind of allies here in our Brexit negotiations, because Germany do have a trade deficit with the UK. So we were hoping that Germany would be a little bit softer on their stance with regards to the Brexit negotiations, but Schäuble's comments yesterday certainly were not soft. So that's something else to have a think about. Right, let's have a look at the calendar for today, because it's not very good. In terms of scheduled news flow, it's actually a really bad day. Data-wise, there's basically nothing of any note when certainly the markets were looking at. So just bear that in mind. There's no data. Also, Draghi, the most interesting monetary policy speaker of the day, has kind of already spoken and he hasn't said anything. Just getting a comment on oil here. So just on Iran, existing oil contracts for Iran makes it more difficult for the nation to join in with production cuts. So that comment is just gonna, well, it's not nothing surprising, but perhaps it's just going to help to continue to see oil prices track lower, which they are at the moment. So next up, really, Broadbent from the Bank of England at 9:10, Bullard at 10:30, a couple of Fed guys later on as well. But Yellen's spoken. From the Fed's point of view, it's 96% locked in now, this hike. Unless you get a dovish comment from any of these three today, they're irrelevant. And I very much doubt any of them are going to be dovish. Certainly George, who's the chief hawk of the whole lot, she's going to be saying, actually, forget hiking in December by 0.25%, let's hike by 0.5 or even more. That's kind of the angle she'll be coming through with. So from a scheduled news flow point of view, really not a good day. And actually, that's kind of been the theme of the week. It hasn't been a particularly good week for scheduled news flow. We've had some data here and there, I guess. Stellar retail sales numbers out of the out of the US, and the UK actually. CPI levels in the UK surprisingly getting revised slightly lower. But generally it's been a pretty uneventful week for data. So keep your eye on some of these really big important prices. That's 125.14 on T-notes. It's actually 1200 handle on gold. For the euro dollar, we got some work to do to get down to the important price, but anywhere around the 105 handle basically. These are the key prices. If any of these get tested or breached, then it's really going to have an impact on markets globally. Okay, and so keep an eye on those prices as we go through the session. All right, that's it for now, guys. Broadbent from the Bank of England is next up in terms of scheduled events, and this is at 9:10. All right, thanks.